$500. That's it. That's all it takes to get started in the Australian share market today. Not 5,000, not 50,000. $500 and a smartphone. And here's what most people never talk about. If you invest just $500 a month into the ASX, history shows that after 30 years, you could be sitting on close to $1 million. So why is nobody starting? Because they think it's complicated. It isn't. And by the end of this video, you'll know exactly how to make your very first investment on the Australian share market, step by step. Let's start with the basics, because understanding what you're getting into is the foundation of everything. The share market is simply a marketplace where people buy and sell small pieces of companies. When a company like BHP, Commonwealth Bank, or Wesfarmers lists on the ASX, the Australian Securities Exchange, it splits itself into millions of tiny pieces called shares. When you buy a share, you become a part owner of that business. You're not just watching the economy from the sidelines, you're in it. Now, how do shares actually make you money? There are two ways. The first is capital appreciation, which just means the share price goes up over time, and when you sell, you walk away with more than you put in. The second way is dividends, regular cash payments that profitable companies make to their shareholders, usually every 6 months. Australian companies are particularly famous for this. The big banks, the major miners, the supermarkets, many of them pay out solid dividends year after year. But is it risky? Yes, absolutely it is. The market goes up and the market goes down. That's just the truth. But here's the thing. Risk can be managed, and the most powerful risk management tool available to a beginner investor is something called diversification. Instead of betting everything on one company, you spread your money across dozens or even hundreds of them. That's where ETFs come in, and if you take away one concept from this video, let it be this one. An ETF, or exchange-traded fund, is a bundle of companies wrapped into a single investment. When you buy one unit of an ETF that tracks the ASX 200, for example, you're effectively buying a tiny piece of the 200 largest companies in Australia, all in one transaction. It's diversification made simple, and it's ideal for beginners. But why bother investing at all? Because doing nothing has a very real cost. Australia's long-term inflation rate hovers around 2 to 3% per year. That means money sitting in a savings account, or worse, under a mattress, is slowly losing purchasing power. Investing in growth assets like shares has historically outpaced inflation by a significant margin. According to historical data from the S&P ASX All Ordinaries Accumulation Index, the Australian share market has delivered average returns of around 9 to 10% per annum over the long term, including reinvested dividends. That's the kind of return that builds real wealth over time. One quick distinction before moving on. You'll often hear the words shares and stocks used interchangeably. In Australia, we tend to say shares. In the United States, people say stocks. They mean the same thing, ownership in a company. That's all. Right. Now that you understand what the share market is, it's time to talk about why you're investing and how to set yourself up with a clear strategy. Before putting a single dollar into the market, you need to know your goal. Are you investing for retirement, decades away? Are you building a deposit for a first home? Or are you just trying to grow your wealth over time without a specific end date in mind? Your goal determines your time frame, and your time frame determines your strategy. A simple and well-known budgeting framework that pairs well with investing is the 50-30-20 rule. You allocate 50% of your after-tax income to essential expenses, rent, food, transport. 30% goes to lifestyle spending, dining out, entertainment, things you enjoy. And 20% is directed towards savings and investing. Even if 20% feels too aggressive right now, starting with just 5 or 10% and increasing over time is still enormously powerful. Now, what's your strategy going to be? For the vast majority of beginners, the answer is simple. Invest in broad market ETFs on a regular schedule and don't try to pick individual winners. This is called dollar cost averaging, and it's one of the most well-researched and respected strategies in long-term investing. Here's how dollar cost averaging works. Instead of trying to time the market, which even professional fund managers consistently fail to do, you simply invest a fixed amount at regular intervals regardless of what the market is doing. Some months you'll buy when prices are high. Some months you'll buy when prices are lower. Over time, your average purchase price smooths out and you're no longer gambling on a single moment in time. You're building a position gradually, patiently, and systematically. And now for the number that should inspire every single person watching this: compound interest. Albert Einstein reportedly called it the eighth wonder of the world, and the data backs that up entirely. According to Motley Fool Australia, if you invested just $500 a month into ASX shares and earned an average annual return of 10%, broadly in line with the ASX's long-term historical performance, here's what happens. After 10 years, your portfolio could be worth approximately $100,000. After 20 years, around $360,000. And after 30 years, close to $1 million from $500 a month. That is the raw, almost unbelievable power of compound interest applied over a long enough time frame. The longer the money stays invested, the more returns build on previous returns, and the snowball begins to accelerate. Now, let's get practical. To actually buy shares or ETFs in Australia, you need an online broker. A broker is a platform that gives you access to the stock exchange and executes your buy and sell orders. Choosing the right one matters, especially as a beginner, because fees can quietly eat into your returns over time. Here are the key things to look for when comparing brokers. First, fees. Brokerage fees are charged each time you buy or sell. Some platforms now offer very competitive rates. According to Finder Australia's 2026 comparison, CMC Invest offers zero brokerage on the first ASX buy order per security per day for trades up to $1,000, making it particularly attractive for beginners doing regular, smaller purchases. Other low-cost options include Moomoo, which charges $3 per ASX trade and is Chess-sponsored, and Stake, which also charges $3 per trade with a solid mobile app. Tiger Brokers comes in at $3 brokerage on all ASX trades as well. For slightly larger, less frequent purchases, Self-Wealth charges a flat $9.50 regardless of trade size, predictable and easy to budget around. Second, Chess sponsorship. This is an Australian-specific feature that's worth understanding. Chess stands for Clearinghouse Electronic Sub-Register System. When a broker is Chess-sponsored, the shares you buy are registered directly in your name with the ASX. They can't be lent out or used by the broker. They belong to you. Custodial brokers, like some international platforms, hold your shares on your behalf, which introduces a small layer of counterparty risk. For beginners, Chess sponsorship is generally the safer and more transparent choice. Third, ease of use and research tools. As a beginner, you want a clean, intuitive interface that doesn't overwhelm you. Some platforms also offer educational content, market data, and analysis tools that can accelerate your learning curve significantly. One note on sponsored content. If you see broker recommendations elsewhere on this channel, always do your own research and make sure any platform you use is ASIC regulated and suits your specific needs. Every investor's situation is different. Once you've chosen a broker and opened an account, the process of making your first investment is straightforward. You deposit funds, usually by bank transfer, using a BSB and account number provided by the platform. Then you search for the stock or ETF you want to buy. If you're going broad market, Popular choices among Australian beginners include VAS, the Vanguard Australian Shares ETF, which tracks the ASX 300, or VGS, which gives you exposure to over 1,500 international companies. IVV, which tracks the American S&P 500, is another widely used option. When you place your order, you'll be asked to choose between a market order and a limit order. A market order means you're happy to buy at whatever the current market price is. A limit order means you set a specific price, and your order only goes through if the market reaches that price. For beginners making their first purchase, a market order during normal trading hours is typically the simplest approach. One ASX-specific rule to be aware of: the minimum first purchase on the ASX is $500 per stock or ETF. This is an ASX rule, not a broker rule. Also important, unlike the American market, the ASX does not support fractional shares. You have to buy whole units. So if an ETF is priced at $83 per unit, you might buy 6 units for roughly $500, rather than buying a fractional amount, as you might in the United States. Now, let's talk about tax, because the tax side of investing in Australia is something a lot of beginners completely ignore, and it can catch people off guard. There are 2 main tax considerations when investing in shares. The first is capital gains tax, or CGT. When you sell shares for more than you paid for them, that profit is considered a capital gain and is added to your taxable income for that financial year. Here's the important part. If you hold your shares for more than 12 months before selling, you qualify for the 50% CGT discount. That means only half of your capital gain is added to your taxable income. Under current rules, effective as of 2026, this discount remains in place, though it's worth noting the government has announced changes that will replace this 50% discount with an inflation-based discount from the 1st of July 2027, along with a minimum 30% tax on gains. For anyone investing today, the 50% discount still applies to gains you realize before that date. If you sell shares at a loss, that's called a capital loss. Capital losses cannot offset your ordinary income like wages, but they can be used to offset capital gains in the same year or carried forward to offset gains in future years. Track your losses carefully in your tax return. The second tax consideration is dividends. Dividends you receive are counted as ordinary income in the year you receive them and taxed at your marginal rate. However, and this is one of the genuine advantages of investing in Australian shares specifically, many ASX-listed companies pay what are called fully franked dividends. Franking credits represent the tax a company has already paid on its profits, at the corporate rate of 30%. Those credits are passed on to you as the shareholder, and you can claim them to offset your personal income tax liability. For lower-income earners, this can effectively make dividend income tax-free, or even generate a tax refund. It's a powerful feature of the Australian system that international investors often envy. A practical tip on tax: throughout the financial year, set aside a portion of any dividends you receive to cover your tax bill. Don't wait until June 30 to think about it. And consider using the government's free Money Smart resources, or speaking with a registered tax advisor if your situation gets more complex. So, where does that leave someone who's watching this right now and wondering whether to actually start? Here's the bottom line. Keep it simple. Start with the $500 ASX minimum. Open an account with a low-fee CHS-sponsored broker. Choose a broad market ETF, something that gives you exposure to hundreds of companies at once. Set up a regular contribution, even just $100 a fortnight or $500 a month, and let dollar-cost averaging do the work. Don't try to time the market. Don't panic when prices fall. Don't check your portfolio every single day. And importantly, don't wait for the perfect moment, because the perfect moment doesn't exist. What does exist is the power of time in the market. The data from Vanguard Australia is clear. A $1,000 starting investment with $500 added every month over 30 years based on the actual performance of the S&P ASX All Ordinaries Total Return Index, grew to over $800,000 by mid-2025, from $18,000 in contributions. That is compound interest at work. One important reminder, this video is for general educational purposes only and does not constitute financial advice. Every investor's circumstances are different, and you should consider seeking advice from a licensed financial advisor or referring to ASIC's Money Smart website before making investment decisions. Start with 500. Stay consistent. Stay patient. The share market has been one of the most reliable wealth-building tools in Australian history, and now it's more accessible than ever. The only thing stopping most people is getting started.